decided to step down as the leader of the Liberal Democratic Party. With the hope that the next administration will fulfill the duty and its responsibility to the people, I would like to pass the baton to the next leader.
No, I was surprised because I knew him, I liked him, and he's just now stepping down. A little bit surprised. I found him to be a very nice man, actually. We dealt very well together.
President Trump says he is surprised by Japanese Prime Minister Ishiba's decision to call it quits just after striking a trade deal. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Ishiba's resignation leaves Japanese markets adrift and heightens investor uncertainty. JPMorgan Securities Chief Japan Equity Strategist Ria Nishihara will join us on why she thinks things can only get better from here. As OPEC Plus defies doomsayers with another oil production boost, we drill deeper into the reasons for the cartel's confidence with veteran analyst Fereidun Fesharaki.
In a month or 2 months, I think India is going to be at the table, and they're going to say they're sorry, and they're going to try to make a deal with Donald Trump.
And we'll ask India's chief economic advisor whether the 50% tariffs will have a dire enough impact on the Indian economy that will force the country to apologize to Trump. Our top story, Japanese Prime Minister Shigeru Ishiba announcing his departure after weeks of calls for him to resign. Ishiba's short tenure was marred by a series of election disappointments that saw the ruling Liberal Democratic Party lose majorities in both houses. Markets are left in limbo as investors weigh the next leader's fiscal spending plans and implications for the Bank of Japan's rate path. Japanese markets are out for lunch at the moment, but here's a look at the trading in the yen and futures ahead of the reopen later. We've also been hearing from our guests on Bloomberg TV today with their views on the situation. Have a listen.
There's, I think, a profound sense that the party is completely out of touch with voters.
I'm looking at a bunch of weak prime ministerships continuing on into the future.
Prime Minister Ishiba, who's now stepping down, one of his sort of signature achievements, I think, while he's been in office, was his astute management of relations with the opposition. And whoever the party selects now to replace him is probably going to have to draw on that expertise.
There's going to be a lot of expectations about economic stimulus going forward. Watch out for sectors like industrials, part consumer discretionary. All of those will likely see some choppiness over the next month or so as, investors brace for the next month.
Let's discuss the impact of Japan's political uncertainty on markets with Bloomberg politics and economics reporter Sakura Murakami in Tokyo. Also joining us, Rie Nishihara, Chief Japan Equity Strategist at JPMorgan Securities. Rie was a former Bank of Japan official and also studied under Governor Kazuo Ueda. Sakura, let's start with you. Give us a sense of where we are right now. We know that Ishiba's resignation was expected. It is the timing. It came sooner than most people anticipated.
Yes, Prime Minister Ishiba over the weekend found that there was growing support within the LDP to see him stand down. And I think we can say that basically he just felt that he didn't have the support that he needed in the party to kind of continue over the next few months. So that's why he probably decided to stand down last night. And we're going to see more momentum over the coming weeks over who to pick for the successor, and that also speaks to how the LDP wants to reinvent itself. It's seen dismal election results, part of the reason that Ishiba did stand down, and it's going to have to find a way to reconnect with voters, to reconnect with the public. And so there's going to be more cues and kind of more signs as to how the LDP plans to rebrand itself over the next few weeks.
Rie, in terms of market reaction, how are you assessing it?
Yes, yen gets a bit cheaper and yields get a bit higher. I think the focus going forward will be who will be the successor, and there will be several main candidates, and one of them are calling for Abenomics, more expansionary fiscal policy and monetary easing. So market has to price in with a certain probability of that. So market reaction is that direction as of today.
Well, I guess key to markets would be what the next premier stands for, and also BOJ normalization. What happens now, given the uncertainty that's possibly on hold for the rest of the year at least?
I think within 1 month, first, the LDP presidential elections will be held. Now, according to the media reports, October 4 will likely to be that date. So on that date, the new prime minister or the LDP president will be elected, and then prime minister to be confirmed. And with this new cabinet, how will be the relationship with the cabinet and the BOJ? It will be the focus. But I think as I said, depending on the cabinet, depending on who will be the successor of the prime minister, the market expectation of the monetary policy and the physical policies will be different. Now, among that contenders who will likely to be the successor of the Ishiba, Prime Minister Ishiba, now, as I said, Ms. Sanae Takaichi, who is former national security ministers, is seen may call for monetary easing or more expansionary physical policies. So in a case of that, under those scenarios, the market may think there will not be no chance for the Bank of Japan to hike rates. But I think it is too early to think about that this scenario will be most likely or not. So the market will wait to the election and also to listen to the candidates' policies.
And when it comes to candidates, Sakura, it's not just Takaichi, there's Motegi, there's Koizumi. Talk to us about the front runners.
Yeah, as you mentioned, Motegi's already thrown his hat into the ring. He's announced his intention to run for the leadership. But the main focus will probably be Takaichi and Koizumi for a while. Takaichi came in second in the previous leadership race, and Koizumi came in third. And they bring two very different things. They bring different things to the table for the LDP. For Takaichi, as Rie mentioned just now, she's more of a fiscal expansionist. She's seen as Abe protege of former Prime Minister Abe. She'll probably appeal to right-wing voters and to the more conservative factions of the party, whereas Koizumi is seen as more of a reformist. He's the son of also reformist former Prime Minister Junichiro Koizumi. He's 44, young, fresh-faced, very media savvy. So they bring two very different things to the table. It'll be up to the LDP to choose which of these leaders, or possibly someone else as well, but who can rebrand the party, who can really guide the party to a future election victory.
And Rie, of course, markets are keeping an eye on the yen in particular. We saw the yen weakening on the back of the news, but some say perhaps yen weakness is limited given what the Fed is likely to do, 50 basis point cut possibly on the table, and that could be, that could put limit to yen weakness going forward.
Yes, exactly. As you say, now the yen faces two different forces. One is U.S.-Japan rate differential, or is now becoming smaller. The now Fed rate cut cycle to start, and a BOJ rate hike probably either in October or in January next year starts. But regardless of that, usually yen appreciation is expected outcome. But this this time, one of the reasons who slow down this yen appreciation pressure is this situation in politics. As you said, a part of this probability where that market expect further yen depreciation and higher JGB yields, I think that slowed down the yen appreciation pressure. And another issue is U.S.-Japan negotiations. 550 billion USDs, Japan investment to America fund, which is very large scale, and also, individual corporates such as Toyota or SoftBank commit to invest in the U.S. So that's demand-supply relationship also slow down the yen appreciation at this point.
Rie, you'd imagine that given the weak yen, lower oil prices, Japanese stocks are attractive.
Yes. So what I was thinking about is now Fed rate cut cycle is going to start, and then but in history, when Fed rate cut cycle starts, yen appreciation pressure is also come together. But this time, yen appreciation will be very slow, will be manageable. That big macro pictures, Japan equity market is seen, getting a following. So that is a reason the strong Japan markets recently.
Rie Nishihara of Japan, JPMorgan Securities, and Sakura Murakami of Bloomberg News. Thank you so much for your insights today. Just some breaking news to tell you about. This has to do with the much anticipated China August trade data. China August exports in USD terms rising 4.4% year on year. That's below estimates of 5.5%. Remember, the exports has been quite a bright spark for China. Exports in USD terms rising 4.4% versus estimates of 5.5% in August, and that's according to the Customs General Administration. Estimates that range from a positive 3% to 7.6%, according to 22 economists. Imports in USD terms rising 1.3% year on year. The estimate was 3.4%. So, on balance, a weaker than expected trade numbers out of China. Well, still to come, OPEC Plus pushing ahead with more oil production at its latest meeting on Sunday. We'll have analysis with FGE Next and ECA Chairman Emeritus Fereidun Fesharaki. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on oil prices after OPEC Plus announced an agreement for a modest production boost in October. The group says it would restart 137,000 barrels a day of output, defying warnings from Wall Street that the move risks compounding a supply glut. This signals that the alliance is firmly committed to reclaiming the oil market share ceded in recent years to rivals like U.S. shale drillers. Let's discuss the outlook for energy markets with Fereidun Fesharaki, Chairman Emeritus at FGE Next and ECA, an international energy consultancy. Dr. Fesharaki is well recognized worldwide for pioneering oil and gas market analysis and studies of the Asia-Pac and Middle East energy market since the early 1980s. Fereidun, good to have you with us. When you take a look at oil prices today, they're actually higher. So OPEC is probably right. It's still a very tight market.
Yes, OPEC is right that the market had expected a bigger unwind, and 137,000 barrels per day is too small. And I think OPEC is going to look at this, and if they find that there is no impact on the market, they might double or triple, as they did last time. So they would increase the level of unwind. But the inventories are still tight. Until the inventories build, and then, all this IEA 2 million barrels per day glut, nobody believes. Until you actually see inventories building up, then there will be no impact on the prices.
Well, the goal for OPEC is actually to regain its market share of 30%. It's close to that right now. It is hovering at about 27%. Do you see OPEC continue raising production at every meeting from here?
Well, this recent agreement means that from now until next October, they will unwind. And if they think the market can take it, they will unwind even more. The question really is that once they get to a 2 million barrels per day surplus capacity, if they go anything below 2 million barrels per day, the market becomes very unstable and jittery. So actually, once they do this unwind, it is the end of the unwind process, because beyond that, creates instability to the markets.
So basically, what we're saying is that the market has enough demand to absorb all the unwinding of OPEC members. I'm just wondering, we've heard from Trump himself saying that he wants prices to get below 60. Is that a possibility given what we're seeing right now?
Yes, I think that's a serious possibility. End of the year or first quarter of next year, that this can happen. And then as inventories will tell us when. But I would say below 60, the first quarter of next year is possible. Mid-50s is definitely possible. And then that would have a big impact on the U.S. shale production. So the supply side will go down, which gives a boost to the prices also. So these things are interactive, but we have not seen the real impact of this unwinding as yet.
What assumptions are you making about demand from China? Today we just had its trade data, weaker than expected. Exports finally showing the impact perhaps of tariffs. That might impact consumption as well as confidence in the country. What are you seeing in terms of Chinese demand?
Well, in China, gasoline and diesel peaked in 2023 and 24, so it's already gone. Whatever growth you see is on jet fuel, in naphtha and other petroleum products. So the growth in China is less than 100,000 barrels per day is nothing. And gradually, by 27, 28, it'll go to zero. So the Chinese story already clear. And it is interesting that somehow the Chinese demand peak and the U.S. production peak happens about the same time. There is a message that something really very big is happening in the markets.
How about in terms of the peak for the rest of the world? Some say perhaps it would peak in 2026.
No, the rest of the world, I am sure it won't peak before early 2030s. But for Asia, outside of China, the peak is 2040. So there's a lot more demand in Asia which can come in. And Asia would be still the engine of the growth worldwide.
The Europeans are imposing a new cap on Russian oil. What impact will that have?
Well, it doesn't really work. It never worked before. It doesn't work now. It just creates inconvenience and makes the dark fleet even more profitable. So that's all there is. The cost of transportation goes up. But the dark fleet still has a spare capacity. So my guess is that it can be accommodated. But countries like India, they receive the oil in delivered basis. So to some extent, it doesn't matter really who delivers it, as long as it meets all the regulations for shipping, safety, and so forth, then it can be delivered. But does it make any difference? The Russian oil will flow as much as before. We see no decline in Russian oil production or exports.
In fact, we're seeing a record in terms of Russian oil production.
Absolutely. The Russian oil production is at its highest numbers that we've seen for a long, long time. And now with unwinding, the Russians can produce more because they are part of the unwinding process. So actually, it makes no difference. So we go back to the old story that oil market is like a swimming pool. If you take one bucket from one side to another side, still the same pool. All the oil flows, and sanctions don't work.
And I'm just wondering where the U.S. stands in terms of this new cap on Russian oil. It's yet to give the okay. What do you see the U.S. doing?
I think eventually they will give the okay. The $47.60 number is just plucked out of the air. And $46.60 for crude oil, but the cap on gasoline and diesel is $100. It makes no sense. Whoever designed this kind of thing doesn't know ABC about the oil markets.
Is there capacity for India to buy even more oil from Russia? It has said that even with the cap, it will continue to buy Russian oil. How much more do you think India can?
I think India will not buy more. And in fact, I am sure that for October, imports of Russian oil into India will drop by 250,000 barrels per day. So there will be less buying. So I think that the levels that they have been recently, pretty much the peak.
What are some of the trends that you're looking at to, I guess, to view the trajectory of oil prices from here?
I think we are going to look at a slow decline. And again, it depends how fast they unwind. But as the inventories build by the end of the year, of early first quarter, there will be some weakness. But to go get them below 60 is not so easy. That's what Trump wants. And that is what I think OPEC Plus is also resigned to. But the prices are very resistant to going down. And every time they announce bad news, the price goes up.
So what would it take to get prices below 60, as Trump is quite determined to get it there?
Well, what it needs is a much weaker demand than we have, and a much bigger, faster unwind than we have. It can happen, and I think it will happen by the first quarter of next year. But it is, the markets are strong. Market is basically fighting back, says, I don't want to go down.
But Fereidun, when you take a look at Asian economies in particular, we're already seeing slower growth with the political turmoil in countries like, Indonesia as well as Thailand, for instance. That may weigh on growth even more. Might that then mean, demand for oil gets dented?
I think it does. Actually, there is something else that you didn't mention, but very important, that now, this year, 50% of the global oil demand growth is biofuels. And so biofuels take a bigger and bigger chunk. So oil-based demand is much, much smaller than the numbers that are the headline numbers. So gradually biofuels, which are mandated, not because of economic, because of mandates, they eat into it. So it becomes weaker and weaker and weaker. And that's why the oil demand peaks by the early 2030s. But still we have 3, 4, maybe maximum 5 million barrels per day more demand to create before we peak. So it's still ways to go. But by 32, 33, I think we are at the levels which impact us. So
oil prices by the end of this year and by the end of next year, what would your predictions be?
I think by the end of this year, maybe 62, 63. By the end of next year, 58, 57.
All right, Fereidun Fesharaki, always a pleasure to have you with us today. Fereidun Fesharaki, Chairman Emeritus at Nexen ECA. Still to come, we speak exclusively with India's Chief Economic Advisor, V. Anantha Nageswaran, after officials cut the sales tax in a bid to support the economy against President Trump's tariffs. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. India is proceeding with caution after President Trump appeared to soften his tone against the South Asian nation. Trump on Friday downplayed tensions with New Delhi, even after the U.S. pushed forward with a 50% tariff on many goods from the country.
Well, I'll always be friends with Modi. He's great. Prime Minister, he's great. I'll always be friends, but I just don't like what he's doing at this particular moment. But India and the United States have a special relationship. There's nothing to worry about. We just have moments on occasion.
Prime Minister Narendra Modi, for his part, says he deeply appreciated and reciprocated the sentiments. For more on this, let's bring in our India trade and economy reporter, Shruti Srivastava in New Delhi. Shruti, put this in perspective for us. Friends again?
Well, too much has moved, I think, too soon in the last 1 week. We saw Trump officials, his trade advisor, Navarro, Commerce Secretary, Mr. Lutnick, them ratcheting up tensions with India, saying that India's continued purchase of Russian oil was funding. It continued to fund the Putin's war in Ukraine. However, Trump's somewhat positive comments on U.S. ties with India, it seems to signify some sort of, thawing of chill that had set in between the relationships between the two nations after weeks of tensions. So difficult to say if it's actually a clear signal on thaw, but yes, some positive development for sure.
Is it enough for talks to actually resume? An indication of when that might happen?
Well, again, India is treading with cautions on the comments which have been made by Trump, though Modi was quick to seize the moment and, immediately put out on social media that he welcomes and India reciprocates the comments made by Trump. But India is treading cautiously. In his post on X, Modi did not, unlike in the past, Modi did not call Trump his friend. There is this feeling among Indian officials that the comments from Trump's side come, after that picture, a picture of three leaders, Putin, Xi, and Modi holding hands, hugging. So I think that was what the thawing that picture caused some sort of concern among the U.S. administration, and hence the comments. But I don't think so. There is going to be any significant movement on the trade front unless and until there is something tangible that comes from both the sides. So I guess very difficult to say right now if the trade talks would resume anytime soon. They have remained stalled when the U.S. team, which was supposed to come to India for trade talks, it cancelled its visit. Since then, the two sides have not resumed trade talks, and there is no clarity on when the resumption will begin.
Shruti, thank you so much for that. India trade and economy reporter Shruti Srivastava joining us from New Delhi. Meanwhile, U.S. Commerce Secretary Howard Lutnick took a swipe at India during a recent interview on Bloomberg television. With formal talks between the two nations currently on pause, Lutnick tells us he expects India will eventually apologize and come back to the table seeking a deal.
It seems like there's been a hardening of the line, both with President Trump as well as Modi, and a sense that there isn't really a coming together. In fact, that meeting with Xi Jinping and Vladimir Putin and Prime Minister Modi seemed to indicate a coalescing of the BRICS. Do you see anywhere in the next month, 2 months, any type of deal or backing down to a lower rate with India?
I would expect, like you saw it in Canada, right? The Carney got elected with this term elbows up, meaning let's fight with America. They put on retaliatory tariffs. They were all bravado. And what happened? Their GDP negative 1.6%, unemployment rocketing towards 8%. And what did Carney just do? He just finally dropped his retaliatory tariffs. So I think what happens is it's all bravado because you think it feels good to fight with the biggest client in the world. But eventually, your businesses are going to say, you've got to stop this and go make your deal with America. So I think, yes, in a month or 2 months, I think India is going to be at the table, and they're going to say they're sorry, and they're going to try to make a deal with Donald Trump, and it will be on Donald Trump's desk how he wants to deal with Modi. And we leave that to him. That's why he's the president.
Well, last week, India lowered nationwide consumption tax as policymakers step up efforts to boost local demand in an economy buffeted by steep tariffs imposed by the U.S. Joining us exclusively now is Anantha Nageswaran, India's chief economic advisor. Van, good to have you with us. First off, your reaction to Lutnick. He says in 2 to 3 months, India will say sorry and come to the negotiating table.
Well, I'm not going to react to his remarks directly. Of course, the Indian Commerce Minister said conversations were going on and that he does expect something to materialize by November. So I think that is the best possible reaction that the Indian Commerce Ministry, which deals with these matters, has put out. So I suppose that's the response to Commerce Secretary's remarks.
Give us some clarity. Trump also came out to say that India has offered to remove tariffs on U.S. goods. Can you confirm that?
No, I can't confirm or deny that. As I said, Commerce Ministry is a nodal ministry, and I think they are the people who are spearheading the negotiations with the U.S. side. And so whatever they say is the final word on this matter. I have nothing to add, Haslinda.
The final word on the matter right now is tariff stands at 50%. How much will that weigh on India's economy?
I'm sure it is weighing on export prospects right now. And I have mentioned this, that the second fiscal quarter in India, which is basically July to September, and also to some extent the coming quarters will reflect that impact in terms of production, in terms of export numbers, etc. I've also said that my hope is that the tariffs, the additional penal tariff is a short-lived phenomenon. I hope so. And if that is the case, then the impact will be contained inside the current fiscal year. And that impact, depending on how long it lasts, even in this current financial year, it may translate into a GDP impact of somewhere between 0.5 to 0.6%. However, if it continues into the next financial year and we feel the impact fully in the full financial year, then the impact will be larger. We should remember that there was some front-loading of exports in the first 3 to 4 months of the current financial year, which began in April. And August also saw some good export growth. So half of the usual exports that go to the U.S. in terms of goods have taken place in the first 5 months of the current financial year. Yes, there will be efforts made to find other markets, and there are also silver linings for India, and I will probably mention that later. The oil price is well behaved. The GST tax reduction is now going to take effect from September 22. So the final impact may be somewhere closer to 0.5% rather than north of that.
The thing is, not everybody shares that view, Van. I mean, we've had some economists, projecting that India's economy could grow as low as 5.8%. What would it take for you to reassess the number that you have right now?
As I said, we have 6.3 to 6.8 as a range for our GDP number. And we said we will not remove this range at this point after a very good first quarter. And also the second quarter, until August, the domestic economic variables were showing pretty good momentum. If, as I said, as I hoped, that this tariff impasse is not short-lived and turns out to persist well into the new calendar year in 2026, then we will review this. At this stage, I would still stick to the fact that when I say 0.5 to 0.6% impact with the midpoint of 6.5 in my range, it is not too far away from what some private sector economists are putting out. But, we should also remember that the consensus widely underestimated the first quarter GDP figures.
The GST taxes and the cuts which are coming, I'm just wondering how much of a buffer will that provide the economy?
So in the current financial year, I think it will bump up the GDP by somewhere between 0.2 to 0.3%. And the full effect may be felt in the next financial year. And that indeed is a very important buffer. So this rate rationalization has been a fairly significant and profound exercise. And on top of the fact that overall inflation has already been very well behaved, food prices have been lower. So, and if you remember, we have a direct tax cut provided in the budget in February. So you are looking at three important tailwinds for consumption, spending, disposable income, etc. Direct tax cut, indirect taxes, and an extremely well-behaved food inflation. These things can actually shore up the domestic consumption quite significantly, offsetting the export drag that is likely to come from the tariff that the U.S. has imposed on Indian goods.
The thing is, the bond market is pretty much on edge. We saw how yields surged because they're concerned about the fiscal position of India. I mean, what can you say to allay those concerns?
Absolutely, Haslinda. I think we should remember two things. The bond market reaction in India was also in keeping with the pickup in bond yields at the very long end in different Western nations, G7 countries as well. That is point number one. Point number two, the Indian bond market yields have softened since then. The 10-year went to as high as 6.6. And if I'm not mistaken, as we speak, it is closer to 6.47 as you are showing on the screen right now. So there has been a pullback in the bond yields. And again, remember, we promised to bring down the fiscal deficit to GDP ratio by more than half from 2021 level of 9.2%. And we have done that. And we are quite committed to ensuring that fiscal prudence and fiscal stability remain the pillars of our macroeconomic performance in this financial year as well. So we are very confident of being able to meet the deficit target of 4.4% of GDP.
But Van, revenue growth has been weak. Some say that, you can only imagine India will have to issue more bonds to support the spending that it wants. Will it? Will it have to?
Well, non-tax receipts have held up very well, and I think in the recent interview post-GST, the Honorable Finance Minister has spoken about privatization, disinvestment targets, etc., and a momentum being imparted to asset monetization and so on. And there is also room for taking a look at some of the expenditure items, etc. So I think in line with the good receipts and dividends we have seen from the central bank, etc., I think overall we are confident that there will be revenue compensation coming in from non-tax sources, and with expenditure also being closely monitored, etc., with the recent technological improvements actually enabling the government to do very, very tight and efficient cash management. We are confident that we will be able to avoid major slippages in the fiscal deficit target and be close to the 4.4% of GDP, if not at 4.4% itself in the current financial year.
We're seeing warming relations between India and China. We're seeing perhaps the resumption of direct flights, easing of visa restrictions. How should one look at developments in relations between the two countries?
Well, I mean, these normalization efforts, as the Ministry of External Affairs has been saying, have been in the works since last year when the Prime Minister and the President of China met in the sidelines of the BRICS summit in Kazan. So I think this is part of the normalization after what happened in Galwan in 2020.
What could be the next steps in terms of easing investments? What can be expected?
Well, I think the government is considering that. I think it will be premature to speculate on that. There have been several reports in the media. I've also been following that, but I think it will be premature to speculate on what they would be in public. And it won't be a good thing to speculate on what those measures would be in public at this stage.
Van, you've expressed confidence in India's economy. I'm just wondering what you view as the biggest risk for it right now.
Well, sure. I mean, the biggest risk is the tariff uncertainty and the tariff impasse lasting longer than what I hope that they would last, and continuing into the next financial year, and that having impact on sentiment overall, leading to private sector pulling back on capital formation and employment generation, etc., offsetting the very positive impacts coming from the direct and indirect tax relief, etc. So that is the most important risk that we see. But otherwise, we have a lot of things going for the Indian economy domestically. We have had a great monsoon. We have had a very high disposable income in the hands of the public. Oil prices are well behaved. The government is implementing reforms. There is a lot of momentum and trust on deregulation, both in the union government and in the state government level. So the external uncertainties have indeed imparted a dynamism in the domestic economy in terms of both growth, economic activity, and reforms. They will offset some of this drag, but I think it's important to ensure that the current impasse gets resolved soon, and India can actually look at a growth prospect of more than 7% in the next financial year.
So given the optimism you have in India's economy, no need for India to say sorry to the U.S., Van?
I'm not going to comment on that one, Haslinda. I'll leave it to the diplomats to take care of that. Yeah.
We know that the framework for inflation targeting is up for review in March, and you have said before that, the volatile food inflation should not be included in that. Do you still share that sentiment? Do you still hold that view?
Well, I mean, we from a conceptual perspective, in general, any agency has to be given the responsibility to achieve a target over which it has control. Definitely, yes, a central bank should look at second-round effects if they happen, but maybe it is possible to impart flexibility even within the existing framework. I mean, the framework comes up for reconsideration only next year, and the central bank has done the the right thing by putting out a discussion paper. So all views will be aired. And of course, whether we stick to the current approach or we look at something else, one has to look at the net cost and benefits to the economy and the potential for unintended consequences. I'm also aware of the fact that once a framework is put in place, any change that is made, we have to keep in mind the reaction of the financial markets, the bond market, especially given that India is now part of the indices, global indices, etc. So all these factors have to be weighed, and one cannot simply approach it from a conceptual purity argument alone.
Van, before we let you go, the RBI, how much support do you think it will give to the economy?
Well,
how many more rate cuts are we looking at, Van?
I'm not going to speculate on that in public either. It is up to the central bank. They have done a fabulous job so far this year, providing liquidity support, removing some of the macroprudential measures, and cutting interest rates as well. I'm sure the central bank and the Monetary Policy Committee know what they are doing.
Van, always great to have you with us. V. Anantha, Nageswaran, India's chief economic advisor. Thank you so much for your time today. Well, India's just been trading. It's been trading for about 1.5 minutes. Here's how it's looking for the markets as we kick off the trading day in the country. Of course, India's been lagging its peers globally. The Sensex index currently up by 0.3% in terms of the Indian rupee. 88.2637 is that level we're looking at. It is down about 0.1% versus the USD. Of course, that Prime Minister Modi's handshake with China's Xi Jinping providing quite a lot of optimism when it comes to the markets and the economy. Still to come, French Prime Minister Francois Bayrou could lose his job in a confidence vote later today as another casualty of France's polarized politics. We'll have the details. Keep it here with us. This is Bloomberg. Welcome back to Insight. French Prime Minister Francois Bayrou is expected to lose a confidence vote in the National Assembly later today unless he manages to strike a last-minute deal with opposition groups. For more on France's budget impasse, let's bring in Bloomberg's chief Asia correspondent Rosalind Matheson. Ros, the writing's on the wall.
Well, yeah, barring a miracle, we're going to see yet another prime minister lose their job in France later today. The inability of Francois Bayrou to get a budget through a very, very fractured parliament. And of course, the question becomes, if he fails today in this effort and his prime ministership falls, what comes next? Do we have an effort to find yet another prime minister who will face just the same difficulties in parliament, which again is split very much between the far right and the left? Do you find that we end up heading towards a snap election? That's something that the French president, Emmanuel Macron, has said he doesn't want to do. Does pressure rise on Emmanuel Macron to step down? He's also said that's not something he intends to do. He intends to see out his term to 2027. But does public pressure rise for some kind of action here? We're expecting potential protests in France again this week through September. And of course, we all remember the big protests that ran from 2018, starting in Paris and spreading elsewhere over fuel, really morphing into discontent over the cost of living in France. And so you can see for this administration, it's very, very hemmed in. Even if Bayrou stays, more likely that he goes. What is the path forward here for France?
And also for businesses, they're really concerned about the economy. They talk about recession risks. This is an economy with a deficit of 5.8% of GDP, debt at more than 100% at the end of 2024.
Well, that's right. And of course, businesses watching this very closely, because even if Bayrou goes, as I said, what's the path forward? Do we find that a new prime minister has to renegotiate this budget deal? And what does that look like for business in particular? Maybe they get a bit of short-term relief, but then, do you end up having to change the budget deficit again, lift it again back to 5%? So you're allowing essentially debt to run unchecked in France in the long term. Do you see the impact, therefore, on yields in France, almost at one point surpassing Italian yields recently? Do you see the premium demanded for French debt only goes higher and higher? The pressure on business, therefore, only rises. And especially if we do get an outbreak of protests again, can they be disruptive and how long do they go for? So we're sort of in this endless doom cycle in France at the moment where everybody agrees that there are serious problems with the economy, with the budget, but no one's willing to find that path through, or no one's willing to make the concessions to get that path through.
The concern is longer-term political paralysis. How might that impact the rest of Europe? How much of a risk is it?
Well, that is a big question because, of course, this would be, the fourth prime minister in a couple of years and, a big distraction for France at home. You can see Emmanuel Macron in these moments. He tends to try and distance himself, oddly enough, from domestic politics and say that's a matter for the government, for the prime minister. However, he will get invariably drawn in no matter what. And this is one of the biggest economies in Europe, distracted again by its domestic politics at a key point for the rest of Europe. Obviously, you've got big discussions about the future of Ukraine, the need for European leaders to remain very united around Ukraine in this moment and in, discussing these matters with the US President Donald Trump. So, can that maintain its momentum if France again is pulled into its own orbit domestically? There's also a lot of conversation around joint defense spending. How do governments work together on collective defense in Europe? Can they maintain that momentum? Again, France, very big economy in Europe, possibly drawn in to major distraction for weeks or months to come.
So many questions to be answered, Roz. Thank you so much for that. Bloomberg's chief Asia correspondent, Roslyn Matheson there. Now, before we go, here's a look at our show tomorrow. Morgan Stanley Investment Management's Jitanya Kandari will be joining us to discuss the latest developments in markets. Plus, we'll speak with VinFast chairwoman Letty Tutue on Vietnam's corporate and economic outlook, live from the CITIC CLSA Investors Forum in Hong Kong. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.